Hey Bowtie Nation, Joseph Hogue here, and big news for investors in Chinese stocks last night. Ride-hailing service Didi Global, ticker DIDI, announced that it had begun the process to delist its shares from the U.S. exchanges, take those shares off the exchanges, and then apply to trading in Hong Kong. So what was really unthinkable a year or two ago is now happening, and anyone with shares in Chinese stocks like Alibaba, Nio, XPEV, some of those very popular stocks, you need to consider the very real possibility that those shares stop trading in the United States and what to do with your stocks. So what I want to do in this video is I want to fill you in on why this is happening, why Chinese stocks are beginning to delist from the US stock market, whether it's going to happen to other stocks like Alibaba, Nio, XPeng, and what your options are if the stocks are delisted. And what is crazy about this is Didi just started trading earlier this year on the on the Nasdaq. It was supposed to be the year's big IPO. It opened at something like 40 or 50 billion dollar market cap. It was a huge IPO there in June, so it's only a few months out, and you can see the ride has been completely straight down since then. Today alone, 16% lower on that news that it was going to be delisting from the US stock exchanges and apply for listing on Hong Kong. So I want to cover why this is happening, and then we'll get into what is listing, what does that mean on the US exchanges, and what are your options for trading these stocks, and whether it's going to happen to some of these other stocks like Alibaba especially, and Nio, because I know that's another very popular stock with investors out there. So why this is happening is a couple of years ago, the U.S. passed a law. It was a hugely popular bipartisan bill to make foreign companies comply with listing requirements, specifically the audit oversight requirement by the Public Company Accounting Oversight Board, PCAOB, which takes the cake and wins the prize for the worst government regulatory name and acronym. But this was set up, this PCAOB was set up from Sarbanes-Oxley in 2002 after the Enron debacle. If you remember back then, the auditors, the auditors that look over their financial statements, that look over their accounting, and are supposed to double check their numbers, company's numbers, really dropped the ball right there, right? They missed a lot of fraud and a lot of scams that the company was pulling. So the government created this Public Company Accounting Oversight Board, this PCAOB, and I hope that's the last time I have to say that. But the government created this regulatory body to oversee the accountants, okay, not necessarily the companies themselves, but the accountants that are checking all these companies, the U.S. listed stocks, the company's financial reports, right? So these auditors, these accounting firms, like PricewaterhouseCoopers and such, they come in, they look at the financial statements, and they make sure there's no fraud. They make sure everything's accounted for correctly under generally accepted accounting principles. And then this accounting board, this PCAOB, comes in and audits the accounting firm. It doesn't audit the company itself, it audits the accounting firm. Okay, and again, that was just set up to make sure we avoid more Enron scandals. Okay, well, the problem is China won't let that PCAOB do its job. Okay, China will not let its companies, its domestic companies like Alibaba, like Nio, like XPeng, like Didi, it will not let the accounting firms that are auditing those statements be regular or have oversight from the PCAOB. Okay, it calls it a matter of national interest, national privacy, and security. But who knows? I mean, we've just had too many instances of fraud from a lot of these U.S. listed Chinese stocks to kind of wonder if China isn't making it less transparent or trying to make it less transparent for accounting of these companies. So again, what happened is the U.S. Congress said that, okay, if you're not going to allow the auditing firms in your country to be audited or oversight by this PCAOB, by this Public Company Accounting Oversight Board, then you're not going to be able to list in the United States. We can't be sure that those accounting numbers, those financial statements are true and correct, that they're free of fraud. So we're not going to put U.S. investors at risk of this. I mean, totally legit, legit investor protections right there. China just isn't having anything of it. So this law was passed in 2020, just last year. It originally gave companies 3 years to comply with these regulations, right? They could, the auditing firms, the accounting firms in China could get that PCAOB approval, and those U.S. listed stocks of Chinese companies could stay listed. But what we're seeing is because of trade and geopolitical tensions between the U.S. and between China, as well as the fact that China just wants more control and less U.S. regulatory oversight on its companies, this process is getting kind of sped up. This process of where if those companies aren't, don't have that kind of oversight, then they're delisted, they're taken off of the U.S. exchanges. But of course, a lot of this is China just wants more control and to build up its own Hong Kong exchange, right? The stock market trading there in China, in Hong Kong. If a lot of these companies, these multi-billion-dollar companies, are forced to delist off of the U.S. exchanges, they're going to have to take their shares, they're going to have to list them on the Hong Kong exchange, and that's going to be, just going to build up that Hong Kong exchange and more credibility for China. So it's really a big win for China to, to force these companies to delist early, not even waiting for that 3-year period, and that's what we're seeing them do. We actually got news from Didi last night. The news was that under pressure from the Chinese government to delist and list in the Hong Kong exchange, that's what they're doing. They're delisting. They're taking their shares off of the U.S. exchanges, listing them in Hong Kong because China didn't want it to be complying with this earlier rule. But now let's look at, okay, so what does this mean? What is a listing on the U.S. exchanges? What does it mean for your stocks? And then we'll get into, will this happen to other stocks like Alibaba, like XPEV, like NIO even, and what you can do about it. And in fact, I think this could be something of a trading opportunity because what we've seen with these delisted stocks in the past is they fall quickly on that delisting notice, and then even a little bit on when they're actually delisted, but then they pop again. And there are ways to trade these stocks that you want to know about. So let's talk about that. Now, when a company wants to sell its shares on the stock market, obviously it goes through a long process of forms and disclosures and accounting audits, those audits that we talked about. And understand here, I'm talking about selling stocks on the major exchanges like the New York Stock Exchange or the NASDAQ there. There are fewer requirements on the over-the-counter exchanges, and we'll get to that. That's going to be the other option here. So generally getting listed on an exchange not only means you just get easier funding for the company, but also kind of that prestige and greater potential for partnerships or acquisitions from other companies. Of course, because you've got that auditing, you've got those disclosures and forms, you've got a lot more public information that other companies can look at and maybe think about acquiring your company. But those rainbows don't last forever, and a company can get delisted from the exchange, not only on its own volition, not only to seek delisting itself, but can get kicked off the exchange. Right, a company can get delisted if its share price falls below $1 for an extended period, if investor interest and just the volume of shares traded daily drops below a threshold. Or the company fails to file its annual reports on time. So then what happens if a stock delists? So what's going to happen to shares of Didi when they delist from the market? What could happen to shares of XPEV, Alibaba, and NIO if they delist? And the thing is here, you still own those shares. You still own shares of Didi, Alibaba, whatever it may be. They just start trading on the OTC exchanges, and we're going to look at that in a little bit. Now, on these OTC, these over-the-counter exchanges, there is less liquidity. A lot of institutional firms like your pensions, your mutual funds, or other funds, ETFs, they can't invest on these OTC stocks. So a lot of times that's where you get those big sell-off in the shares, like we're seeing today with Didi, where the shares fell 16%. A lot of the institutional investors, a lot of the big money players that are investing in those shares will not be able to invest by mandate, by their own rules, once those shares go to the OTC markets. And again, it's because those OTC exchanges, that over-the-counter exchange, just doesn't have the same regulatory requirements for filing, for forms, for auditing, that kind of thing. So a lot of these institutional investors just don't want that risk of investing in an OTC stock. But you still do own the shares, and this is a great example of this. Some of you are going to remember this. Luckin Coffee was a big name, big stock about a year ago, ticker LKNCY. Back then, I believe it was ticker LKNC something, right? Now, when a stock does delist from the U.S. exchanges and share starts trading on these OTC exchanges, it is going to change the stock symbol, right? It'll usually go to a five letter code for the stock symbol, like you see here with Luckin Coffee. Now, what we saw last year with Luckin Coffee, they got that delisting notice. They had some fraud and accounting problems there, so the shares fell huge on that. And then they were delisted from the NASDAQ on June 29th, 2020, which is right around May, June, right around here. So you see it was it had fallen. It fell to about $1.38 when it was delisted from the NASDAQ, started trading on the OTC. So everyone that owned shares in Luckin Coffee, they still owned the same amount of shares. There was still the same amount of shares in the company. They just had to trade those stocks on the OTC. And of course, most trading platforms, most investing apps can still handle that. They can still allow you access to your OTC shares. I think Fidelity charges an extra fee to be able to trade those, but you still have those shares and you can still buy and sell them. Now, what we saw though is that with that initial sell-off, because those institutional investors were selling out of the shares, because a lot of people weren't quite sure what an OTC exchange was or whether they would have the shares, those shares fell big, and they did fall to like $1.38 here. You'll see on that delisting and when it changed trade there. But you can also see that they've surged since. They have surged to, well, after the 7.6% drop today on real weakness in Chinese stocks, they were trading right around $13 a share. So I think this is a real trading opportunity in a lot of these Chinese stocks, and we're going to talk about that in a little bit. Whether you buy now or hold your shares or wait for that delisting if it does come, or just wait for some of the pressure to come off of some of these, especially some of the larger names like Alibaba, like NIO, like XPEV that might not get delisted, might stay on the U.S. exchanges, and I think that would be a big move higher in the shares. So let's look at some of these stocks, especially Alibaba, that's ticker BABA, because if there was one Chinese stock I was going to invest in right now, and I don't know whether I'll invest in Alibaba or not on this news, but if there was one Chinese stock, it would be Alibaba. This is a great company. It's got something like 20% of the e-commerce market in China, one of the largest e-commerce markets in the world. And it has not been this low since like 2017, right? You see the drop here, 7.7% on the day, one of the largest drops in the company's history. And you can look at the chart here all the way back to its 2014 IPO. IPO'd, it was right around $90, and now it has wiped out so much value just since really the problems with the Chinese government started in October of last year. It hit a high of just over $307. It's now down to $112, so about a third of that. It's lost about 66% of its value, and now it's down to, levels we haven't seen. We haven't seen since 2014, since the year it IPO'd. We have not seen shares of Alibaba down this low. And we're going to get into whether that could be delisted, what's going to happen. But I want to look first at just the fundamentals of this stock, just some of the statistics, because this is a great company. Even if it gets delisted in the United States and trades on Hong Kong, trades on that OTC market, it's still going to be the same company. It's still going to keep growing. Yes, China is taking more control over its companies, over the companies in its market, and that may slow down growth a little bit. But this is an extremely strong company, a fast-growing company with a valuation that is just unheard of, right, for a company like this. If you look at some of the share statistics here, this price to sales, trading at 2.8 times price to sales. So the price of the shares, 2.8 times the annual sales. And what's amazing about this, and we can look at the sales growth. You look at sales growth, it's growing 30% a year, growing those sales 30% a year. If you look at any other growth stock like this, that price to sales is going to be closer to at least 7, 8, 10 times price to sales. Especially if we can, a great comparison for Alibaba obviously is Amazon. It's the Alibaba. Alibaba is the Amazon of China. Okay, so if we look at Amazon, that's ticker AMZN, and if we look at the price to sales on that, and what's interesting here also, if you look at the revenue growth on Amazon, 15%. So Amazon is growing its revenue, growing its sales at only half the pace that Alibaba is growing. And yet it's trading for about 4 times, almost 4 times sales. So, Amazon is growing slower than Alibaba, and yet it is trading for about 42% more, a 42% premium. Okay, and I would say even that, that Amazon price to sales ratio might be a little low actually too. That might be a good deal. But you look at other multiples here. This trailing PE, this price to earnings ratio for Amazon, 68 times. Okay, investors are paying 68 times earnings for shares of Amazon. If we go back to Alibaba and check out what the price to earnings on that is, look at that, 18 times. Okay, so growing slower, Amazon growing slower than Alibaba, trading for 68 times earnings, 277% premium to shares of Alibaba. So, Alibaba the valuation here is unthinkable. And I think the near-term fear in this is a little overdone. That said, delisting is a very real possibility on this. So I think you play this as a trade, maybe in the short term, and then look longer term out. With this 7.7% drop in shares of Alibaba today, I think I will pick up shares here. It is just too cheap to ignore, and especially on the fact that that you still will own shares. If those shares do eventually delist from the U.S. exchanges, you're still going to own those shares. I don't see how the company can get any cheaper than this, on that price to sales or price to earnings basis. And you're still going to own the shares, right? The shares are still going to trade on that OTC market. You're going to be able to buy or sell those shares if it does delist. And I think you're going to make good money overall. It might not return to that $300 price target anytime soon, but even up to $200, even up to $200 a share, which would be very quickly, something that could do very quickly, especially if some of this pressure, some of this fear and tension comes off of the stock. That could be that could be within a year, and that's like an 80% return right there. Okay, so a few ideas here in these stocks. Other stocks like NIO and XPEV, that's ticker NIO. We can look at what those did, and you can see here these all day today. These are the trending stocks because there's so much news, so much fear and uncertainty around these. But if you look at NIO, let's just look at this. Down 9% on the day. Average volume for NIO is 38 million shares traded on a daily basis, which is a huge volume. Today, already, it is now 11:30, and it's already up trading 58 million shares, right? People are just dumping this stock like a bad habit. 9% down. Let's check out the, it's down to where it was in October of last year. So this is one of those stocks, an electric vehicle stock that's really done well into that, into that theme of electric vehicles. And but it's just cratered, right? Since then, it is down to about $32, down from its high of $67. So about less than half. It's down more than 50%. And you can look at some of these statistics too. The valuation on here is just going to be crazy, okay, compared to other electric vehicle stocks like Tesla. So check out the price to sales here, 12 times on a price to sales basis. And we can look at Tesla, see where Tesla is trading at. So if you compare Tesla trading at 26 times on a price to earnings basis or price to sales basis, right? So again, basically double what shares of NIO are trading for. So the idea here is that if you believe in these companies, you believe in NIO, you believe in Alibaba, you think they're good companies, you think even with this Chinese pressure and a little bit more control from the Chinese government, you still believe they can be good companies and create revenue and sales or revenue and earnings in that market, then the valuations on these are really undeniable. It's really unavoidable, that they're going to make money for investors. Now, again, what I'm thinking here is more of a trade right now. Okay, I think these shares are oversold. We've seen they've come down 9% and and 6% in the markets because of that news, because of some of the fear in the markets. So I do think, especially for these larger stocks, this NIO, this Alibaba, I think the share price does come back up a little bit once maybe they release a statement saying they're not looking to delist from the U.S. exchanges, maybe saying that they haven't gotten that same pressure that Didi got from the to delist from the U.S. exchanges. I think the shares go up from here on that. Now, longer term, over the next year, over the next 2 years, because of this new rule that Chinese companies, the auditing companies, the accounting companies need to be audited by this PCAOB, there is still the possibility that these shares, these stocks, Alibaba, XPEV, Nio, could still eventually be delisted. So again, that would still be more pressure on the shares. The price would come down if there was some kind of a delisting, news on those shares. So I think you buy the shares now. You get this short-term profit in there. You wait it out maybe, and either hold the shares or sell the shares until you see some of this delisting notice come through over the next year. If that happens, I think you buy in again, because again, you're still going to own the shares. I think all the fear in those shares at that point, if they do get delisted, all the investors selling out, then the shares are going to hit rock bottom. They're going to be on the OTC market. You're going to be able to pick up shares there, and then they're going to rebound from there. So click on the video to the right for my top 5 investments for 2022, the 5 best investments to make right now for the next year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.